Hello, it's Cameron Moule here as part of a new series called Industry Insight. Today, I've been fortunate enough to be joined by an industry professional that has over 20 years experience in the finance sector. He is currently the Senior Portfolio Manager of Investors Mutual Leaders Fund, Small Caps Fund and the Australian Small Companies Fund. He is Simon Conn. Simon, thank you for joining us today.
Thanks, Cameron.
Simon, over time you managed to consistently outperform your relative benchmarks for each of the funds that you're associated with. How have you managed to sustain this outperformance over such a long period of time?
I think there's no magic sauce to our process. It's really about the disciplined application of an investment process that's been in place for near on 20 years now. And then the key focus for us is to look for companies that have got a strong competitive advantage, looking for businesses that have a recurring and predictable earnings stream that can grow steadily through time. And most importantly, I think in the small company sector, looking for companies that have really capable and consistent management teams who've got a well-articulated strategy and a discipline around the way that they run their businesses. We're also very much a value manager, so we look to buy companies when they're trading below our assessment of their valuations, and we continue, if stocks trade up and above their valuations, we'll trim and exit our positions.
Over the past 12 months, we've seen major global developments, with the UK's exit from the European Union, as well as Donald Trump taking office. During your time at Investors Mutual, have you ever seen equity markets this politically driven, and do you think it's here to stay?
Obviously, in a world of where we're so connected and retail investors and investors generally are so focused on macroeconomic developments, there is a focus on politics. But I think it's about the underlying fundamentals of each of those economies that's key. So yes, look, investors do react, and particularly we've seen the US and North American market react quite strongly to the election of Donald Trump and his promises of reforming some of the regulation in place, obviously cutting back on Obamacare, reducing tax rates and investing more in infrastructure. But I think the key thing that people have to remember is that politicians make a lot of promises and they propose to make changes. But the reality of life, as we've seen here in Australia with our own Senate situation, is that actually getting changes through Parliament and Congress and Senate in the US is quite a difficult process. And I think the caution that we have around Donald Trump particularly is that he lacks a track record in the political scene, and understanding the nature of horse trading and understanding having to trade off and get stuff, actually get material through Congress is much, much harder than I think a businessman with a naive background such as Donald Trump has. So I think the reality of the situation in North America is it'll take a lot longer to bring into place those reforms that he's proposing.
Since late last year, we've seen a shift in the flow of funds from the small and mid-cap space towards the larger end of town, being the ASX top 20. What do you expect the next 12 months to bring?
Look, I think, there has been this rotation. I think, beginning of last year calendar, we saw a rotation actually the other way from out of the top 20 into the small and mid-cap sector because there was a lack of growth in the top 20 sectors of stocks in the market. Then around Christmas time, we did see rotation back the other way, and we saw a big rally in the bank stocks. And now we actually are seeing, I think, a little bit more of a rotation back towards small and mid-cap industrials. Look, I think that the bottom line is in Australia, it is a slow growth economy. It's a grind, and I think with interest rates being low, I see an investor intention being short in sight. People are looking for a quick gain. But I think in this environment, it pays to really look at the longer term and understand why you're buying companies and to stick with good quality companies, which I think will deliver good growth over time, and not to oscillate between sectors. Sure. Obviously, the banks are struggling for growth in the current environment. They generate really reasonably healthy yields, and that's obviously one way that investors can generate a return. But I think looking beyond that sector of the market, I think the outlook for some of the small and mid-cap stocks, I think there's more growth in that sector of the market. It's not a high growth environment, don't get me wrong, but I think there's reasonable value in offering some of those stocks, and I think people have to be very, very selective in this environment.
May has typically lived up to its reputation as a seasonally weaker period for our market, with the market coming off 3.5%. Do you think it's a good time to be buying Australian equities? And if so, what sectors would you be invested in?
Look, as I said at the outset, I think, Cameron, it's really about being selective and looking at each stock situation on its fundamentals. So look, obviously with the pullback, some company share prices looking more attractive. So companies such as Southern Cross Media, which we've been adding to in the portfolios, I talked about on the morning briefing this morning, trading at a PE of 11 times and a yield of 6.5% with a much improved balance sheet. 80% of a radio, if it is a radio business. I think that's quite a resilient business, and we think that represents good value. Obviously, there are other stocks that we're looking at and continue to look at to add to our portfolio, and any pullback does create the opportunity. But I think it really is an environment where people are very focused on the short term, and you do see, particularly with the advent of high-frequency trading and the day traders, the shorting, you see quite large gyrations in share prices in very short-term environments. I think retail investors need to focus on the long term and understand what they're buying, buy good quality businesses when they're a little bit out of favour, and I think investors will do well over the next 2 to 3 years sticking to that strategy.
Sure. Simon, you mentioned Southern Cross Media as a company that you're happy to remain invested in. I thought we'll dive a bit deeper into another couple of companies. Firstly, UK bank Clydesdale, which is the demerged entity from National Australia Bank. Why are you happy to remain invested in this company?
Clydesdale is obviously is Australian listed and UK listed, so it's a dual listed company. It's in the top 100 stocks in Australia, so it's quite a large listed bank. The reason we're attracted to Clydesdale, and if investors think back to some of the spin-offs that we've seen over the years, Dulux came out of Orica, it performed very well. More recently, Shopping Centres Australia was spun out of Woolworths, and it's done very well for our funds. We like stocks that have been particularly a little bit out of favour. So, you know, under National Australia Bank management, Clydesdale was a bit of an orphan asset and didn't have a consistent management team and wasn't managed to a consistent strategy. Now with a much more focused management team, we think there's a really good opportunity for that business to grow its earnings going forward. The new management team led by David Duffy, who's an experienced banking executive, and a really strong management team that he's put in place, have the opportunity, they've articulated the strategy of taking between 690 and 700 million pounds of costs out of their business, which is an enormous amount of cost. So obviously underinvested in under the National Australia Bank banner. They've got the opportunity to take that cost out of their business and grow their earnings accordingly. The bank also has a significant asset base, so it's got a very high level of Tier 1 equity. If they can level the playing field in the UK market between the majors and the regional banks, and APRA, or the equivalent of APRA in the UK, is very focused on that, there's the potential of capital relief and potentially a fully franked dividend, a special dividend coming out of that organisation in maybe 2 or 3 years' time. So it's just a franchise we think has been under-owned. It hasn't been growing its mortgage book to a great extent. I think, you know, where it's focused, the regions in the UK haven't seen a huge housing price appreciation, so it's not a bubble economy. And the UK economy has been boosted more recently by the fall in the pound, which followed the Brexit, and that's given the domestic economy some sort of a stimulus. And we're seeing the European economies, which are big trading partners of the UK, growing at, not a high rate, but, expanding at a nice little clip. So we think it's a business that's fairly, resilient, well provisioned, conservative management team, cost out, special dividend potential or capital relief, and then ultimately and potentially it could be part of a larger organisation. So M&A could play a part in the value creation story for Clydesdale.
A strong performing stock over recent times has been insurance broker and underwriting service Steadfast Group. Why is IML happy to be invested in this name?
So Steadfast has been in the portfolio for some time and has been a very good performer for us over the last 18 months to 2 years. Steadfast is a very strong franchise. It's the leading general insurance broker in the country. Insurance broking, don't get me wrong, is not a high growth business, but this is a business that really speaks to the themes that we look for. Has a very resilient business. The renewal rates of the insurance brokers in the network is very high, between typically 90 to 95% client retention. It doesn't have a huge amount of cyclicality to the earnings, so the commissions that the brokers charge are fairly resilient and generate a good cash flow. And more recently, we're looking for insurance rates that seem to be trending up, which always gives the insurance broking industry a bit of a tailwind. And then through time, we think the business can continue to grow through taking costs out of their business. They've had a large IT program in place, which we think can run the business more efficiently, take costs out. And then also Steadfast, the network, as a listed company, can grow their earnings through buying either stakes or buying out minorities in the underlying insurance broking businesses and enhance their earnings going forward.
Well, we've spoken about 3 companies that you're happy to remain invested in. Is there any stocks or themes that you're currently avoiding at the moment?
Look, we're always very cautious on the contractors and the mining sector, particularly in the small and mid-cap sector of the market. Mm-hmm. They're quite a volatile asset class, and contractors tend to be an asset class or a sector of the market wherever earnings start to expand, you get increased competition, and then companies can lose a lot of money on contracts. Obviously, fixed price contracting can be a high risk business, so we tend to steer away from the more cyclical businesses and prefer to invest in the more steady eddy businesses that can deliver consistent outcomes. The Steadfast of the world, the Shopping Centres Australia, those sort of businesses, Southern Cross Media, as I mentioned at the outset. they deliver a much more consistent outcome for our investors.
Sure. All right, Simon, well, thank you for joining us today. Congratulations on the continued success, and we look forward to hearing from you soon.
Thanks very much, Cameron. Thank you.
Cheers.